Does whole life insurance actually work? Meaning you're looking at a whole life insurance policy, you're interested in the cash value, you see these projections that look good. You think this is a good area to put money. I like the idea that it's safe, liquid, tax-free. I'd like to access my cash value for opportunities, but does it actually work? I've seen, I've read, I've heard a lot of bad stories about whole life insurance. Yes, the illustration looks beautiful, but what happens if it underdelivers? Because this is what I hear about people who actually take out whole life insurance products where it just underdelivers and they're not happy. Well, in this video, and really this entire video series, we are going to look at policies that are more recent. They're about 5 years old. Some are a little bit older, but policies that were issued right around 5 years ago, and we can see how they were designed, what the original plan was. In some cases, you'll see an event where people stuck to the plan, meaning they had a plan to pay an X amount of dollars, and they paid exactly that dollar amount in for that exact time frame. You'll see some people plan to pay into it for 5 years and not another penny thereafter, whereas others had a plan to pay into it for a certain period of time or a certain dollar amount. Life happened, they had to pivot. How are those policies performing? So tracking the actual performance is something we like to do, and you're going to get some insight as to how whole life insurance policies actually perform more recent policies. If we go back 5 years, you'll see with almost every life insurance company out there, if you look at what the dividend rate was 5 years ago compared to what it is today, it's declined, it's come down. Now, if you'd like to see policies that are older than 5 years, we do have videos. Some are public on our YouTube channel, some are not. We make it available to those we are working with, but please reach out. We can certainly send some of the public ones if you have a hard time finding them on our channel, and we can certainly talk to you about making the other ones available if you're interested in seeing some historic policies that were issued back in the 70s, 80s, 90s, and early 2000s. But let's get on into this video. So the majority of the case studies we will look at in this video series will be about 5 years old. And what the majority of these people have expressed, these are people that we work with, I'm still working with on a regular basis. The want, the desire here, there are many desires as far as why they took these policies out. But number one, I want as much money as I can have upfront. So the attraction to a whole life insurance policy, the reason why a lot of these individuals took policies out is because of the safety. If there's a market correction, when I say market, stock market, or economy, if there's a recession, life insurance has always been a secure area to position money that will produce somewhere between 3 to 5%, just continues to appreciate over time. The long-term benefit is attractive, the liquidity, the tax-free feature, all that good stuff. But what's not attractive at all is typically the lack of equity in the early years, meaning I take that whack, I've got a lot less money than what I pay in, and that's frankly why people don't do it. It's too much of a hit right out of the gates. So the number one question or the objection that people had, I want, is what? To have as much money as I can up front. So we did just that. You'll see what was projected and then what they actually had. How to do that, or I should say what to look for in this case, is you typically want to see between 80 to 90% of your payment in first year cash value. That is an indicator that the policy is set up with a minimum base premium, maximum cash value, and maximum flexibility. There are some high early cash value products that do credit a little bit more than 90%. You'll see between 90 and 95% of your payment in cash value in the first year. But on average, it'll fall between 80 and 90% in the first year as far as what to look for if you want maximum cash value upfront, in addition to maximum cash value long-term. Next piece, access to capital for opportunities. So why the upfront cash value is important is, before I even hit on that, an advantage to cash value life insurance is what? When you look at the liquidity feature, I can access my cash value and it continues to compound as if I never touched it in the first place. So if I have $100,000 in cash value, it's growing by a net rate, an internal rate of return of 4%. If I let that 100 grand sit and grow, or if I borrow $50,000 against it, if I take a $50,000 loan, I continue to receive the 4% internal rate of return on the full $100,000 as if I never touched it in the first place. No lost opportunity cost. Company does that by collateralizing the death benefit. Point here, why I mention that is that's a draw or a point of attraction to cash value life insurance, but having access to capital, particularly in the early years, is very important. Meaning if someone has to take a huge hit up front, say it's 50% or more in year one, and they don't have access to money, they don't care about that benefit because like, I don't have access to the capital. I'm not going to give it up for a long period of time. So typically we want to break even anywhere between 4 and 5 years on average, sometimes a little bit longer depending on the company and product we're looking at, but on average 4 to 5 years, sometimes 4 to 6. But that's what we want to look at in the break even. Break even means that I have equal or greater value in cash, so equal or greater cash value than what I've paid in. For example, if you're paying in $100,000 per year for 5 years, by the 5th year, you've paid in $500,000 total. If I have $500,000 at that point in time, I break even. Whereas the early years, I have less than what I paid in. So that's not my break even point. Okay, let's continue on here. Next point, ability to pump in large amounts of money into a policy. So this has to do with policy design and MEC limit. Key word there, ability. So the individuals here are not just going to automatically throw money into the policy. They're planning on it, but they want the ability to do so. What that also means is in the event that life happens and they don't have money to fund the policy with, maybe they're dedicating their resources elsewhere, they want the ability to scale back on their payments too and not be penalized. So this has to do with policy design and setting the MEC limit, which is policy design in itself. But when we design that policy for maximum cash value, if someone is paying in, call it $100,000 per year, or they want the ability to pay in $100,000 per year, how we would design that policy is exactly like this. They would have a premium of about $10,000. They'd have a term rider attached as well, which would be minimal as far as a cost standpoint. But then the ability to throw another $90,000 per year into the PUA rider, which we see accelerate the cash value growth. I've got access to that money right off the bat. That's really the key to maximizing the cash value of a life insurance policy. So point here is they want minimum expenses and the ability to plow the dollar amount in that they want to pay into a policy. So flexibility is very important there. They don't want to feel obligated to a big bill. Nope, give me the flexibility and give me maximum cash value. They didn't quite say it like that, but you know what I mean. Flexibility to adjust funding. So this one's huge and company selection does play a role here. And this is something we talk about frequently. Just to hit on 2 examples real quick. Company rules. We typically recommend the 4 major mutual companies. We primarily use MassMutual and Guardian. When you look at their PUA flexibility provisions, MassMutual has a couple of them, but if I'm going to just give a simplified overview, if you set things up properly, MassMutual, you can adjust your PUA payment 1 time per year, every year, without any medical underwriting at all, provided that adjustment is made and paid on your policy anniversary date. So that's when your premiums due, your policy anniversary date. If year 1, I pay in $50,000, year 2 comes, I say I'd like to add more. As long as I do it when that premium is due, it doesn't have to be the exact day. I've got a 60-day window, 30 days before through 30 days after to make that change. We can adjust the amount on the back end, and then you can send the money in. Very flexible there. So 1 time per year without underwriting is the key. If I want to add funds at random to a MassMutual policy, I usually have to go through underwriting. They do have some PUA riders available that allow me to avoid that, but it can be kind of a hassle and a lot of people don't like it. Guardian, as another example, is very flexible. They will allow a policyholder to commit to the minimum only and throw additional PUAs into the policy at leisure. Mobile app, online portal, can send in a check. Very, very flexible. The policy design, however, is very important there as far as how much I can add in the PUAs. Being able to make sure I can pay in 10x is very important. We've got other content on that. I'll talk about it all day and just keep talking, so I'm going to stop myself. And growth rate or internal rate of return is maximized. This one, I think you'll find interesting. So when it comes to the growth rate, the internal rate of return on a policy, the break-even point, hitting it when I want it to hit it between years 4 and 5, something that's very important here is if I take a policy out and I'm able to max fund it, meaning 10x my base premium, fund up to the MEC limit, really for the first 2 years of a policy, you'll see that your break-even point generally will fall between years 4 and 5. And this is based on reality, not just illustrations. You're going to see reality, some policies that have lived the test of time. But if I'm able to max fund during the first and second year, which when you look at a whole life insurance policy, when are the expenses heaviest? First and second year. So if I'm able to offset that in a sense by juicing the policy, that's what really beefs up the cash value up front, hits my break-even point earlier. I'll see the strongest guarantees. Everything will look good moving forward. And what's interesting is when we look at the different case studies, you're going to see some examples where people did that. Not all of them. This will be a really fun case study as we progress through the different examples, where some people stuck to the plan, some people adjusted, some max funded just years 1 and 2, paid the minimum thereafter. But the purpose of this case study, or these case studies as we look at each one in the next 5 videos, is really to provide information, examples. If you're trying to figure out, hey, I think I want to do this, or I don't know if I want to do this, can I see some actual case studies? That's what we're going to go through here. And we're going to look at, in most of them, what was originally projected, and then what actually happened in a declining dividend interest rate environment. Here are the names of the friends we will be looking at here. We're just going to use abbreviated names here. KM, CL, GP, LJ, and AD. Anthony Davis of the Los Angeles Lakers. I'm just kidding. Then company selection, original plan, and how it is performing. So we're going to have a lot of fun. If you have any questions on any of the material I went through here, or additional things or questions you have, if you're considering a whole life insurance policy that you say, hey, here's a plan I have. When you've looked at actual policies, have you seen this actually happen over time? Please leave them in the comments below. I do look at those, and we can certainly respond via comments or create some case studies. And you can email us direct as well. Hope this helps. Talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.